Yalimada, everyone. Thank you for joining today's retirement savings webinar. My name is Azra Bandali, and I serve as a volunteer on the Aga Khan Economic Planning Board and will be your moderator for today's session. I would like to welcome you all to this retirement savings webinar. Each year, February is observed as the Retirement Savings Month to highlight the need and importance of all of us to actively save for retirement. This webinar is the first of two webinars being offered this month. In addition, several regional sessions will be offered in partnership with our national partners, Charles Schwab, for those Jamaati members who do not currently have retirement savings account and would like to start saving for retirement. Please look out for more information in your regional insight. Before I introduce today's speakers, I want to cover a few housekeeping items. As a reminder, this webinar will be recorded. The link to this webinar will be sent out in an email along with a survey link. The format for today will last about 75 minutes. We encourage our listeners to submit questions in the Q&A toolbox. We have dedicated time after the presentation to discuss questions. We will cover details about the importance of retirement savings, various types of retirement accounts, and investment options. I would like to first introduce Jamil Habib, member of the Aga Khan Economic Planning Board USA, to say a few words.
Thank you, Azra. Yali Madad, everyone. On behalf of the Aga Khan Economic Planning Board for USA, I would like to welcome everyone this morning for joining the webinar. The last several years, as Azra mentioned, we have been observing February as the Retirement Savings Month, during which we have activities nationally as well as regionally to bring focus to the importance of retirement savings. Today's webinar marks the beginning of the Retirement Savings Month for this year. I would like to mention a few points this morning or afternoon in the Eastern US. Maulana Hazar Imam has given us guidance on many occasions regarding importance of the quality of life, which is especially important during our golden years. With longevity of life, mashallah, we are living longer. It is very possible that we may each have a retirement of 20, 25, even 30 years, or even longer. It is also a known fact that costs associated with healthcare, as well as long-term care, increase quite a bit during the later years of our life. What that means that in order for us to have a quality of life during our later years, we need to put away enough money during the years when we are able to work, which is around till age 65, 68, or perhaps 70 for some of us. And that's the challenge before us. We need to put away enough funds during our working years so that they can last all through our retirement years when we may not be able to earn a living anymore. This is where retirement savings comes in. That's why it is absolutely necessary that each one of us should have a plan to save for our retirement. If you are married, please make sure that each spouse has a plan for themselves. If you don't have a plan, then please start one during the Retirement Savings Month. Also, as Azra mentioned, and some more details will be mentioned about the regional webinars that are going to be held, and those would be an opportunity for you to perhaps do that. And just having a plan is not enough, right? Please make sure that you are funding it regularly and appropriately. Let me repeat. Please make sure that you fund your retirement savings regularly, right? Which could be monthly, quarterly, or annually, and that you are putting away enough money, right? Because one thing to make sure that we get to our goals is by contributing regularly and obviously the right amount so that we can get to where we need to be for our retirement. Please remember that during your working years, you can get a loan for your house, your car, you can even finance your education, but you cannot get a loan from a bank to finance your retirement. A bank will not give you loan to fund your retirement. Keep that in mind, something to think about, right? Mashallah, with the efforts of our volunteers and with help from the Jamaat in the last few years, we have made a lot of improvements in the number of Jamaati members who have started retirement savings. However, we still have many who have not yet started. EPB is here to help, and we can help you in whatever way that you need help with to get your retirement savings started. Um, some details will be shared with you as to how you can get in touch with the team. We hope that inshallah, the next time the leadership is reporting the end of term reports to Maulana Hazir Imam, just like they did last time in 2019, when we had mentioned to Maulana Hazir Imam that every year in February, we are observing February as the retirement savings month. And we hope that next time we are in front of Maulana Hazir Imam, that we are able to express to him that many, many more members of our Jamaat have now started the retirement savings and are appropriately funding it, inshallah. Before I conclude, I want to express my gratitude to all the volunteers who have worked very hard to present the retirement savings month to you, including our presenter today, and to all of you for spending part of your Sunday with us. I hope today's webinar is beneficial for you. Thank you, and Yali Madad. Back to you, Azra. Azra, you might be muted.
Thank you. Thank you, Jamil. Next, I'd like to give a warm welcome to our presenter for today, Roshan Ajani. Roshan is based in Dallas and is a certified public accountant and certified financial planner. He has been a public accountant since 1993 and a financial planner since 1999. He works at Ajani Wealth Management and is a financial planner with Raymond James. Thank you for joining us today, Roshan, and I would like to pass it over to you to kick off our presentation.
Thank you, Azra. Thank you, Jamil. Yali Madad, everybody. Such an honor and pleasure to be here back again for the 4th year. Thanks for the national team. I'll start with a story which I did last year also. Once a prisoner who was about to be sentenced to death was brought in front of the king. And before the king could announce his death sentence, the prisoner says, "King, if you spare me 1 year, I can teach your horse how to talk." So king took a pause and said, "Can you really make my horse talk?" And he loved his horse a lot. He said, "Yes, if I don't, you can kill me after 1 year." King said, "Hey, I got nothing to lose." He said, "Go ahead. I'll give you 1 more year to live and you teach my horse how to talk." As he was leaving, the guard says, "Listen, there's no way you can teach the horse to talk." The prisoner says, "Listen, 1 year is a long time. In 1 year, who knows, the king might forget about my crime. Who knows, 1 year, king may die, or even better, the horse may start talking," right? So 1 year has gone by. I'm back here again. So glad to be here. In today's session, we will be talking some very, very important concept. As Jamil said, one very key word and that's this session, I think, takes us towards that goal of what Hazir Imam is talking about, quality of life. That is what the core of this presentation is, that we all make living. And in fact, right now in our session today, there are more than 30 different group of people who make the living in different ways. So making a living is one thing, that we have 30 different ways that we are making it. Is making a life, is that what Imam is talking about? And more specifically, what he's talking about is quality of life. So I believe the session today would help us. What we do in our day-to-day life, we work hard. We, no matter how you make living, in fact, there are more than thousands and thousands of ways in this country now that you can make living. And when you are doing that, you're very focused on what is urgent. What is urgent? Everybody has that in their profession. It is what is important that's eventually you want to focus on. And that's what Imam talks about. in the quality of life that once you grow, grow your wealth. And we will be talking about three very important components. Wealth in retirement accounts, and through retirement, there are two very important part of it. One is in retirement, there's an income component, which kicks in at the end of when you retire, and more towards once you have your retirement going, you're focused a lot on the income. While you are accumulating, while you are working, while you are 20, 30, 40 years, if you're 20 years old, you are focusing quite a bit more on how do I grow my wealth? So simple question. This is a question that how we grow our wealth. Today we'll be talking three very broad and very, very important concepts in our thing. And this question was raised many years back. If you ask this question, how do you grow wealth? Well, let me answer that question. What many years ago, what was answered by one of our richest men, Andrew Carnegie. He said, "Do you want to know if you will be wealthy?" He answered the answer with another question: do you know how to save? And I think that's the main part of this presentation, that we want to focus on that word right here, how to save. And the second very important component about we'll be talking a lot, which I want to bring it up front, is about the tax planning. We will be talking a lot of tax planning concepts in this presentation. And just wanted to bring that up front, that some people may have that, oh, are we talking avoidance of tax? Yes, of course. Tax avoidance is legal. Tax evasion is criminal. So we're not talking evasion, we're talking avoidance. We want to plan. Avoidance is lowering your tax bill by structuring your transaction so that you can reap the largest tax benefits. That's very important. Tax avoidance is completely legal and extremely wise. So we will be talking about a lot of tax concepts which are there in the tax code. Sadly, many of us are not able to understand and take full benefit of it. They go long ways in building your wealth if you understand. And my goal today is that by end of the session, we understand completely some of these concepts which are so powerful, which is going to go long ways if you can really understand. And we will give you a lot of time to ask questions because these are complex concepts. So we will stay here till we answer your questions at the end. Meanwhile, the third one, of course, is about compound interest. So if you savings, you do the tax benefit, and you do compounding of interest, those are the three powerful tools that you use to grow your wealth. And we will be discussing all that through these next few slides. So when we talk about retirement savings, you think about your retirement, these are the questions or these are the statements that most people have, that, hey, I want to retire before 70, 60, 50, whatever that number is, comfortable at home. And these are the few important. We all want to travel when you retire. And again, one more correction, I would say my definition of retirement does not have to be at 70 or 90 or 60 or whatever, 50 or 40. It is retirement. It is retirement, not retirement. So you just, whenever you are comfortable, it could be at any time, then you are comfortably building your asset. The whole purpose of this whole thing is that let your money work for you. Some point in time, no matter how hard we work, how long we want to stretch, but we will not be able to work. So let the money work for you from day one. Even when you're 20, you're putting money aside, you're building your wealth slowly, because ultimately that's what our goal is. Let the money work for you and do it in a way, in accounts which will help you grow wealth faster, because we all have limited resources and we have limited time to get to the goal where we want to go. So we will share some of these important things. So here are some of the very important goals that people have. And well, first polling question, Azra, it's to you.
Thank you. So we'd like to take a minute to take a quick poll question for those of you who are on the line. The question is, if you are currently 35 years old and make $50,000 annually and want to retire by the age of 67, How much money do you think you will need to save for your retirement? So you guys should see that in the poll feature should have popped up on your screen. Please select the answer which you think is correct. We'll give about 20 seconds.
So can I also answer?
You can answer.
I know the answer, so I won't be fair.
Again, just to repeat the question that's in the poll, if you are currently 35 years old and make $50,000 annually and want to retire by the age of 67, how much money do you think you will need to save for your retirement? Is it 50,000, 500,000, 2 million, or 5 million? Please answer within the Zoom poll function that should be on your screen. Great. So we have everyone's results. 8% of people said 50,000, 21% of people said 500,000, 50% of people said 2 million, and 20% of people said 5 million. Roshan, I'll hand it over to you.
Yes, and all the answers are kind of correct. I wouldn't say wrong answers, especially the person who thinks 5 million is the right answer because they're thinking their income is going to grow. And people who have chosen less number, I would say think replan, and we'll talk more about to justify it, to explain and to make you understand that the correct answer is a whole lot more than what some of you have chosen below 2 million. So 2 million is the right answer. And here's the explanation of how that is. And yes, it's mind-boggling when you think about middle income people who need that much money to retire. But then again, she said they are 35 and they have about 35 years more to go with inflation, with cost of living. And then Jamil has mentioned that we're talking 25 and 30-year retirements now, that even if you retire, the RMD retirement age for most people is 70 and 72 and all that, but 95 has become a very normal. When we plan, we put our plan dates for people till 95. So yes, the answer is 2 million. How do we come up with, and here's another few stats before we jump into our core of the program, that this is what people are thinking. You know, this is where we are as a country. Only 10% people in the country have a written plan for retirement. This is shocking because, I mean, we plan, how many of us go to the airport and say, okay, let's decide where you want to go. It doesn't work that way for vacation. We don't start construction of our, nobody in the engineering world will start their building their house without a plan. But here we are, we have only 10% people have a written plan. So we have some challenge. Houston, we have a problem, right? That's a common phrase we hear. 17% believe they have enough money for their retirement only, 17%. And what is even more shocking, that 30% of Americans find retirement plan is tougher than starting an exercise regimen or a diet. And this number is going to show up. That means they don't even have, for many people, the later is too difficult to not have a plan because they think that is even more difficult than that. That's shocking. Okay, so going back to this thing, if you are close to retirement, you're about to retire, within 5 years, 1 year, 3 year, whatever. So whatever your monthly expense today is, you will at least need 75% of that. The way it works is you might have some social security, or some of your expenses will drop with the kids going away and your house paid off, assuming, and a lot of things. Now, I know many people on the East Coast and New York and California and Washington, and they're saying, what, this is my rent you're talking about. No, so just to give that number, so you can multiply what you are spending today, what you will need, and the number comes shockingly where we need to be, because understand, when we're talking in general retirement, we are saying we will not work, our day-to-day income, whatever how you make through whatever profession you do, that goes away, but your expenses are not going away. So you are relying on the assets that you have built to draw on that income for next 25, 30 years, and hopefully keep that income where that asset where they are, just live out of that income and pass it on to whatever you want to do, your goals of life. You can do that. So that's the ultimate goal. So looking at this number, let's going back to one slide. When you are getting close to retirement, building your retirement strategy is there. Once you get closer, and even when you're building your retirement assets, you have to have some defensive assets, some offensive assets, and that's the way how you build your portfolio. Because even now, somebody who might be 20 years away from retirement, we just saw what happened this month in January in the markets, people who are following who are invested. And what we saw 2 years ago in March with the COVID, market can move up and down significantly. And especially when you have built your assets, you have to be very careful that you don't lose a lot of it with the volatility, or at least in principle that you see your portfolio go down. So defense and offense is always the case that you build prudently, as Imam has used four very powerful word when we talk about future planning and economic planning and wealth building. It's prudence, thoughtfulness, thoughtfully, wisely, and carefully. These are the four words I can recollect very often Imam has used: prudence, thoughtfully, wisely, carefully. And these are the very important words that we have to use. They are very important estimates of how you can calculate your retirement living. Clearly, you have to define your goal, calculate how much you might need. And as you get closer, that becomes even more and more important. But the last one is what is very, very important, because most of us in this call, and we'll be spending a lot of time on accumulation phase part of it, having a budget is extremely important, because this is where I see, as I started with, in our country, I think we are giving so much little focus on savings and so much more on income. That's, if I were to ask this question right now, I think as to what do you make, I think we'll get an answer in some milliseconds from most of us. We can respond there very quickly what you make. But if I were to turn around and say, where is your money going? Which expense items is your money being spent on? What categories? Many of us will take a lot of time to figure out or not have the answer right away. So income is not wealth. Income we make in all different ways. 30 different professionals are here. Income is the beginning of wealth. It probably is even not even that. That's one of the component. But till you don't save, you don't even begin the wealth accumulation. So having a good budget, knowing where your money is going, is the first thing that how you will start saving, and saving into right ways. And we'll talk about as soon as this slide comes in, we'll talk more about that. But that's the key. You have to save to begin the process of wealth accumulation. And that's the core of this thing that we are talking about, because you save and then you go into looking for how can you take that savings and use into different ways. Tax comes next, compounding comes next, and all that. But first thing comes is savings, right? So there's a good saying that a small leak can sink a big ship. If you don't know where your money is going, and month after month you're focusing on increasing your income, and that's all we do. If I ask to raise a hand in person, I think most of us will say that our income has gone up significantly in the last 5-10 years. The bad part, what happens is, as your income goes up, your expenses catches up with you. It's amazing how that works for people I know in my profession, that my clientele, they're spending a whole lot more than what they used to, because now their income has gone up, and that's the problem, that we are not able to save. So again, focusing on budget is very important. Save now, have a capacity to absorb financial shock. This is very, very important, because things happen. We just have COVID on so many different professions were hit hard, dentists and doctors, and some initially, and hospitalities and all that. So plan for that, have those things in place so we have some cushion. Now, here are some of the very important accounts that we will be talking about. This is, again, from retirement from IRS, that Uncle Sam has given us a lot of benefits in the tax code. And most of these accounts are very new in the sense 1980s, where the deferred 401k plan concept started. This is comparatively to Social Security, which is getting almost close to 90 years now. And this is a new concept. But in last 10, 20 years, it has really, really picked up because people are realizing that how important this is. And in fact, retirement planning is the most common component of all financial plans. If you go around the country, you'll see is this where the retirement planning is the most important thing in people's mind. Okay, so there are two very important, that's the basic plans, basic accounts, which I think we all know about. People who work and who don't work in the big companies, they all have this option for traditional IRA and Roth IRA. What are those? We all know in very nutshell. Traditional IRA is pre-tax, where when you can put your money into these accounts every year for each person. It's individual retirement account. So it's individual accounts. So if you're married, you have to open two accounts because it's attached to your Social Security number. Individual account, just because you're married, you can do joint account. You can put two in one account. You have to have separate accounts, and it is pre-tax dollars where you can deduct. So whatever money you put into these traditional IRA account, you deduct it on your taxes. You don't pay tax on that amount, and that's wonderful. Well, who is it good for? And that's something we're going to talk a lot more in the tax planning and question answers. And we want to make that clear because this is information, but concept is very important. It may be ideal for people who are higher tax bracket. Now, what is a higher tax bracket? It might be a different answer for different people at different age, because we still have, after all the efforts we have done, there are 7 different tax brackets: 10%, 12%, 22%, 24%, then 33, 35, and 37%. So it's a staircase. So how and where, what should be a best way to use it? We'll talk more. The second side of the retirement accounts, which Uncle Sam gives you, which was started probably in the mid-90s by the senator who passed the bill, Senator Roth, and that is very, very powerful. For most people are underestimated the power of Roth. I want to make sure we all understand this, because this can go a long way when we go to financial planning at the end, 20 years, 30 years, 40 years for some people, because this is very understood, I would say, concept. This is after tax money. So right away, people say, oh, so I don't get to deduct anything. Yes, you don't. If you are putting $12,000 for a couple, or $14,000 if you're over 50, you don't deduct. Well, then right away they say, oh, why should I? Well, because it's tax free and tax deferred, of course, during just like any other IRA is tax deferred and tax free when you pull money out at the end. And that is very, very powerful, and we'll want you to understand and use that concept, especially people who are younger, people who are just starting. You should definitely focus on Roth IRA, especially people who are in a 10 or 12% tax bracket, pay the tax up front, but imagine not paying the tax in the future. That makes a lot of sense for people who are younger. So here are the age limits. For people under 50, the limit is 26,000. Over 50 is 7,000. Now, the difference between take advantage of the tax benefit today. Here's another back summary of that. If you think your tax bracket will be much lower when you retire, again, very hard to say, but most of us, if you are a professional, chances are very good that you will have more in the future, not less. So this is for people who really have very high tax traditional IRA. You take advantage of the tax today, especially when you are higher bracket, 33, 35, 37, it becomes a different pull towards traditional and Roth, and we'll give you a little bit more specific answers as we go along. Both have penalties attached to it. These are retirement accounts. They are designed for your retirement, and they must be used for that purpose. So if you put in money, of course, you can take the deduction. But if you take it out, not only that you're going to pay tax on that money right away, you put it in today, you're 30 years old, and 3 years later, you say, okay, can I pull my money out? Yeah, you can, but then Uncle Sam doesn't like that. And they say, we'll tax you on that money, plus we'll hit you with 10% penalty because you are not doing what you said you're going to be doing, put in money and holding in your retirement account, any retirement account, whether it be traditional Roth, 401ks and all that, they all have this 10% penalty. For Roth, the penalty is a little different. You have to hold the money in Roth IRA for 5 years, and you have to be 59 and a half years to avoid penalty. Both has to happen to avoid penalty. One very important difference, which makes it lean more towards the Roth, is there is no RMD, required minimum distribution in Roth. In a traditional IRA, you have to start withdrawing money at 72. So this is a big difference for people who are thinking and planning longevity, people who have, giving money to the heirs or stuff like that. So this becomes a very powerful tool that you do not start your RMD, or you do not have to start RMD at 72. You can hold on the money till you're 90 and not even take out a penny from your Roth IRA, and that's fine. Not in a traditional IRA or 401 case. Okay, so just to give you an example, a little bit more specific focus answer, that say somebody starts today, 22-year-old, with $6,000 a year, right? So in 10 years, assuming that no increase happens, the limit stays the same, $6,000 a year. In 10 years, that person would have put $60,000 aside. At 7% compounding, that money, 60,000 will grow to 94,000. You'll say, okay, not a big deal. And yeah, it is not a big deal at this point because 10 years. Now, what the fun of compounding happens as the time goes by. In 20 years, you have put in 120,000, but your money has grown to 260,000, 270,000 with 7%. After 40 years, you have put in 240,000, but your money has grown fivefold to 1.2, almost 1.3 million. Now, for most people, now at this point in time, this 22-year-old is only 62-year-old. So there's still one more double before you can retire. Think of that. If you double one more, and yeah, you have put in 300,000, but now you have 2.5 million. And in fact, even more, one better, that you don't pull out all the money in your retirement. So you have probably one more double you can do from 72 to 82, some of their money. And you double that and you can see the power of compounding. Your $1 could be 16 or 20 or $30 in your retirement by just leaving the money aside, letting the money grow. That's the power of retirement. That's what we are talking about, that how to use, because these are tax deferred accounts. Yes, you will pay tax. So what is going to happen? Let's assume you built up this money and now you're going to pull money out in 10 years instead of waiting longer. And you say, I want to pull out 10 years. So you take out 1.2 million over the 10 years. That comes to about $100,000, $104,000 or so, 100,400 for total of this amount. So you put in $6,000 a year, you start taking money out because you have to pay tax on that, right? So 22% tax. So you will get about $83.69 a month. Same thing, same numbers, same everything. In the Roth, the way it works is you defer, you pay the tax up front, but you never pay tax at the end. So now the same scenario has happened if this person would have just chosen Roth for 40 years deferral. Now you have 10,730 coming instead of 8,000. So you are literally not paying the 22%, assuming everything came as a 22% bracket. That's a big difference between traditional and Roth. Yeah, it's a little bit painful when you're putting money and paying the taxes, but then it's a very, very powerful when you are retired and you don't even have to take all that money in one time. You can wait. You can choose when you want to take, which year you want to take. It doesn't work that in a traditional or a 401k. So there's another very important concept, tax code, which gives you, switching a little bit here, there's a savers credit, which additionally on the tax benefit that you get for putting money aside in a 401, in a IRA, a 401ks, that people who have low income, Uncle Sam wants you to save money and put money aside for your retirement. There's a savers credit of 50% if your income is below 41,000 AGI. If your AGI is even below, this is for married couple I'm talking here in this group. And as your income goes higher, your credit goes lower percentage wise. And once you cross 68,000, there's no credit. So this works a good planning tool for people who are in business, people who have elderly parents and who can help you in your business and make them work. It's good for their health, pay them salaries also, and they can make some money at the same time. They can defer more money into yours, so they have Social Security wages going. They have their put money aside in your retirement account, and gives you even credit. So literally, they can walk away with almost $41,000 with no taxes. So here's an explanation of how that works. Taxable income is about 41,000. They both contribute about $4,000 into their traditional IRA or Roth IRA, whatever you do, it doesn't matter. You still get the credit. So in the Roth IRA, you won't get the deduction, but in your Roth IRA, you do get the deduction. By the way, the standard deduction is about 27,000 now for seniors. So you get $2,000 in credit, 50%. So literally they could walk away applying this credit to their tax bill and literally pay almost zero in taxes with the right planning. Okay, now people who are in small businesses, people who are not having the luxury of having a 401ks that work very quickly, for those business people, there are a couple of plans that works very, very powerfully. And these are employer-based plans. So you as a small business can set it up at your business level. And these have to be set at the business level, at the corporate level, at your, by the employer. Simple plan and SEP plan. These are two most popular for small businesses, and the 401k plan, of course, for small businesses. The same concept. They both are tax deferred. They both, in the simple IRA, employees contribute just like your 401k. The limits are a little lower, $14,000 for 22, and there's a catch up also for people over 50. So you can contribute up to $17,000 in a simple IRA. This is good for, limit is 100 employees or less. If you are a small business, Uncle Sam says you can set up this. This is very low cost, very simple to manage. You put some money as a matching, 3% for employees who participate, 2% mandatory if you choose not to, you give them 3%. So this is a very simple plan to manage, very low cost. And of course, the tax deferral you get when you put money, ideal for business people like a gas station. They have husband, wife working. They have two employees, and you give them a choice. Hey, I'm setting up a simple. They both can defer $14,000 each. And if they're over 50, they can do $17,000. If the participants don't participate, and if you've chosen the 3% giving, you don't have to do the matching if they don't participate. So it kind of works good for small businesses very well. Employees or employer both can contribute. Employees will defer their salary into it, and employer will match. SEP IRA is a very, very popular among small businesses, professionals, more of the people who are high end but no employees, maybe consultants who are working. This is not a best way to go, but the way it works is a SEP, Simplified Employee Pension Plan. All the money that is contributed in this plan is by the employer. So there's no employee deferral, but employer match only. It's kind of a pension plan, so it's given to everybody who is in that business. If there are 5 people working in that business, everybody gets the same percentage as the owner will get it, or the main person will get it. If you are a doctor and if you have 4 people in your thing, it may not work, because if you want to choose to give 20% to yourself, of your salary, you will have to give to everybody. So it is only good for most of the time, practically. It works for people who have no employees or maybe one employee or something, and you want to give that person matching equal to what you are going to get. So you cannot discriminate between, okay, I get 25% as the owner and my employee only get 5%. It doesn't work that way. It has to be same. And any size business can do that, of course, but as I said, after 1 or 2 or 3 employee, practical purpose of this thing almost goes away cost wise. What becomes more important, we'll talk next, and I'll take a water break, and Azra is going to take over for the poll question.
Sounds good. Thank you, Roshan. So the next poll question that we have is for those who are married. We'd like to know, if you are married, does your spouse have a retirement account? Yes or no? So we'll give it just a few seconds for those of you to submit your answer within the poll function in the Zoom. And if you're not married, you don't have to answer this question. Okay. All right, so for those who are married, 64% of people say yes, their spouse has a retirement account, and 36% say no, their spouse does not have a retirement account.
That's a big number. Thank you, Azra. So very, very important. I think this is one area that I think we can really do better, because you are only taking half the benefit of what Uncle Sam is giving you. Because if you have income and you have the cash flow, which you, especially for people who are making good income, there's no reason for you not to take that benefit of the tax code, because you can double it. It does not have to be both spouses working. I know many one of the spouses working and one is not, taking care of the kids. And that's okay for them not to, but you can still open an account if you have income. Say, for example, if you make $100,000, one person in the family makes $100,000, the other taking care of the children at home and not working, you can open 2 IRA accounts. Although one has no income, you can still open 2 IRA accounts or 2 Roth IRA accounts, whatever. In fact, at that level, you will say Roth IRA, not traditional. And whether you have income or not. So once you file a joint return, the condition is you have to be filing as a joint tax return between you and your spouse. If only one person makes money, you can still open 2 Roth IRA, 2 IRA accounts. So that is, and in fact, that's better if you can save that much amount. And for at $100,000, recommended from my end, I would say you should be saving at least 15% of the income. Everybody else, if you're making very, very low income below 50,000, 10% is still a minimum that everybody should be saving as a percentage of your income. As you go higher, 200,000, the number should be 20, 25%, 300 would be 30%. At 500,000, you should be saving at least about half of the money somewhere. I mean, either retirement account is probably a better reason, and I'll go more about it. So 401k. Now, this is my favorite. A lot of people, this is changing. Oh, we have another poll question. Go ahead.
We do. Before we get into 401k, we just have another poll question. So the question is, why is it called a 401k? A, the amount of money you need to retire is 401,000. B, the section number in the federal tax code. Or C, the amount of government pays you each month when you retire is $401. Again, if you could put your answers in the poll that's in the Zoom function, that would be great.
So
Okay.
Azra wants to make sure you guys are up and not sleeping. So good. Thank you, Azra.
When I first started, I
That's a
didn't know what
good
for. I
check.
thought it was A. So I'm glad everyone knows. The correct answer is the section number and the federal tax code. Good job, everyone.
Yeah, great, great. So yes, it's Internal Revenue Code section 401k talks about this, and just down the same section, there's a 403b for people who work for hospitals, governments, and teachers, and there's a 403b. And over the years, last 20 years, so that I am in business, it used to look very different. 403bs were very different in the beginning, 25 years ago, 30 years ago, but now they both have almost a similar benefit. They look the same, they feel the same, and same limits and everything. So here's the answer. The answer is 401k is a tax code. So now, very, very important concept, 401k, another very, very sadly understood concept. It's the most powerful thing that you can do, even better than. So we just talked about two component savings, and we talked about tax benefit of traditional and Roth IRA, which is very small limits, 6,000, 7,000 limits. Here's the big one, and the business plans that we have. Simple plans have $14,000. SEP plan have a very significant amount of money that you can contribute to 61,000 in your SEP IRA, but then the limitation is you should not have too many employees because you'll have to match for everybody. So here's the one which is most common. This could be used, set up at business levels with your small businesses, or it could be set up, of course, for people who work, and more and more and more every year, that number is going up significantly where employees are offering 401k. Most of the employees are giving matching. That number is going up significantly. And then not only that, but even more important, that the percentage of matching they are doing is even getting higher. So it used to be very common, 3%, then it went 4% average, and now it's averaging about 5% matching per employer who offer. And that's the power that I want to explain, and want to make sure that all 200 plus people who are on the call, 100% of us do understand this call, are taking benefit to the maximum. EBB said, I won't get my paycheck if I have even one person not participating. So make sure everybody understands, and I will take your questions to explain this concept. Very, very powerful. The limit on this thing itself to start with is very high. People under 50 can contribute up to 20,500 for the current year, and 27,000 if you're over 27. So that is very, very important. Higher limit, you can defer a lot. Talk about 401k options. You get a match from your match contributions from your 401k. Now, as I just said, 6%, it just doesn't attract a lot of people to say, okay, 6%. I'm going to explain that a little bit more. The way it works is, say, for example, one person works and makes $200,000 at a good company, $200,000, and the employer, most common now, become a 6% match. The way it works is, if you're 50 years old, you can defer $27,000 at 200,000 income. You're talking 22, touching 24% bracket, say 22% bracket, $27,000 right away. You deduct almost $6,000 from your taxes. You don't pay tax in your current bill if you max out your 401k. That's the one big savings you get right away. It's a traditional 401k. So you don't pay tax on that. Plus, your employer at 6% match giving you $12,000 free without any taxes into your 401k if you contribute at least 6% or more. In your case, if you're taking the max, that's even better. So not only you do tax savings, plus you get $12,000 from your employer, and that's recurring every year. So now let's talk about that. You have $27,000, you save almost $6,000 in taxes, and you got $12,000 free from your employer. Talk about building wealth. Nothing better than this. If you can understand this, never miss a year, never miss a dollar, which comes in matching. yes, if you have issues and you're very tight, at least everybody should be taking. I mean, at least 10% would be a good number for somebody who's making 200,000. Should be at least 15%, or better, the whole 27,000 if you can. And that is very, very important. That's the one thing that cannot emphasize enough, would help you grow your wealth faster than anything, because it's tax deferred. It is powerful. You don't pay tax on it. You keep the tax money in your account. Yeah, you're going to pay tax later. But somebody who's in their 20s and 30s, you talking 30, 40, 50 years later that you pay the taxes. So right away, you tax the deduction, you get the matching. Very, very powerful. I've seen in my own practice those money grow very, very fast. You could have the same 401k if you're a solo earner. If you have a IT consultant, you're any consultant that don't have employees, you can set up a solo 401k where only husband and wife can participate, two spouses can participate, and same concept works. In that, even it's better that you can do a 25% matching for yourself, because there's no other employees, they're solos, and they can do matching with the same 27,000 deferral if you're over 50, or 25 under 50. And you can get 25% matching from your business, your own business, and deduct fully on your taxes, on your business tax return. So this is the one area I think we'll talk more in the combination of how somebody who is what is the ultimate tax haven of deferred and Roth, taxable income, traditional IRA. These are all ways that you can save money. Capital gain taxes, in a taxable account, you pay capital gains taxes. In traditional IRA, you pay income taxes. In Roth, you don't pay taxes at the end. That's the very important part, again, for the same thing. Oops, we got another poll question. Ezra wants to make sure that you're listening. So.
Awesome. So the next poll question that we have is, what is the earliest age you can retire to receive Social Security benefits? Is it 42 years old, 52 years old, 62 years old, or 72 years old? So again, what is the earliest age you can retire to receive Social Security benefits? And we'll give it just a couple seconds for everyone to submit their answers. Okay, and 90% of people answered correctly. The correct answer is 62 years old is the earliest age you can retire to receive Social Security benefits.
Okay, well, just because you can, the answer is you should not. And we'll talk more about the reasons and numbers right now next, because yes, you can withdraw at 62 for some very rare reason that you could potentially take money that early, because you get a haircut, big time haircut for every year before your full age of retirement, which now for most of us who are not very close to retirement, that number is 67, and that number is going to creep up slowly every year. Probably we're looking at somewhere about 70 by next 10, 15 years, because that has to happen so they can save some Social Security benefits for long term. So for right now, the full age is 67. For every year early you take, you lose 8% for life. So at 62, you lose significant amount of money, almost 30% or so from your full benefit, which if you would have waited till 67, you get, I'll give you the numbers example also in a few seconds. And for every year you can delay your withdrawal, you add 8% for life. And that is the important part. And that's something we want to emphasize. So you have your mindsets while we're planning. People in the 30s, 40s, and 50s, they are thinking, just keep this number in mind. So this is a very good example of a person who lives till 84 and claims the Social Security at 62. They're very low Social Security benefit. By the way, the average is about 1550. If you divide the average Social Security person, average takes about $1,600. On the high end, the maximum you can get is about 3,100 a month. So, and how it is calculated. So this person, just because they started at 62, they will get in the lifetime while she lives to 84, 220,000. Now, if they would have waited till 66 and then started, they would have got more. So literally you're losing money by taking early. And what we recommend, in fact, I have seen few people who have just retired in my practice. We are pushing, and most of the financial planners are leaning towards 70 years age, because your RMD starts at 72 now. So it makes more sense if you can work for another 3, 4, 5 years. With our professionals not being that hard physical labor, people are easily able to work till 70 and even beyond. For, as we say, retirement, not retirement. So we can change our profession, try something different, keep going, because that's how you see the benefit of how you can withdraw more with the same life. Now, what if this person lives to be 94? The same person, if she would have lived to 94, then the amount of money she would have received is 423,000. Now, this is at a very low base. If you have 3,000 base, I mean, you're talking probably upwards of $1 million, $250,000 difference between 67 and 70. Once you run the numbers, that's a very, very significant amount. So it all depends. The only time you will compromise and take early, that you have some health issue, some terminal illnesses or whatever reason, or if you're married and your spouse have a higher base, and there's another tax planning goes into it. We'll probably have another session. We do a lot of those, but just keeping in general, just to give you a little glimpse of what you should be thinking of. 70 is a good number. How is it calculated? It's calculated over the best 35 years of your income. That's how you come with your total Social Security. You have to work for 10 years, 40 quarters to qualify. And then the best 35 years will define as to what you're going to get in your Social Security benefits. Okay, so now what happens? Well, we just talked about some very, very broad concepts. I'm going to just bring it all up and give you some tax planning concept put together. But our EPB team has put together, I know in the 90s when I was board member and, at the local level and all that, we used to give 3 choices because that's best we could do. Now they have given us a lot more choices, different good companies that you can talk to them and figure out where you go. Just keep in mind, there are a few ways that all these companies, businesses make money. When you do self-manage, you are doing most of the work and you're opening an account. The managed one is you give somebody a professional, okay, can you manage my money? And there's a two structure, either you pay commission or you pay fees. Depending on the size of the portfolio, you pay either of the two. You do have to pay. If you hire somebody, nobody's going to work for free. Understand that. So either you're paying commission or you're paying fees. You choose depending what fees they charge and what commission you're paying and what your assets balance is and what comes out better in your favor of. That's the purpose. Is in the retirement accounts, you have to keep the cost low, because that's the key. Because the more businesses, how they make money, of course, when you open an account, there's a fees. Well, in most of these cases that our team has researched, these comes with no minimum balance fees. But then the companies, they do have, when you make investment, there's a 12(1)(b) fees, there's transaction fees, there's if you're fee-based account, that's there. So there are other ways that companies make if you use their funds. There's a management fees that is attached to it. So read about that depending on your asset base and what you want to do, how much time you want to spend, because cost becomes a very, very important factor if you're putting money aside for 20, 30, 40, 50 years. Even that 1% haircut on your asset through cost can be several $100,000 cost to your retirement account. So that's why they have put, and in fact, we have some regional also coming up. This is just one of the national program that we are starting with, but there are so many different, and I think you will get notified. The next one is coming up very, very soon, next week, in fact, or so, in Central Region and all of these dates. And so let's put together what I just said. I gave you a lot of information. I know, sorry, but that's the only way to pass on the information. But now we're going to do some tax planning, because this is where the core of, we put together everything, answer your questions, make sure you understand the concept of how you can utilize these tax deferred accounts. So let's go back and let's go one by one and summarize it so you all understand. And we'll take some questions. I'll stay here as long as you all have questions, so that you understand and clarify. And I think most of the time, most people have learned more from listening to scenarios, as we used to do case studies. We're not doing case studies, but we'll take some of your questions to clarify what we just talked about even more by numbers. So first thing, you have choices of retirement accounts. Everybody has a choice. Everyone in this country can contribute at least some money into your retirement account. Let's start with that first. So you say, hey, I am just a little employee working for a very small individual owner. They don't have anything. I mean, they're just very, very tiny. They have nothing. Can I do anything? Sure, absolutely. If you make decent money, that number, let's put it as Einstein said, make things simpler, but not simple, but not simpler. But to make things very simple, if you are making as a married couple 110,000 in 2022, you will be falling into 10 or 12% bracket. Under 110,000 in 2022, this is AGI. So now, if you are below that, I personally would recommend, in my opinion, you should be focused on taking a Roth, because you pay the tax, 10%, 12%, whatever it is, and then you never pay tax on that money. It's become tax-free for life. So that's the first thing. Everybody gets it, whether your employer has a 401k, simple, SAP, nothing. You can still come and take your IRA. Now, what if I have an income of $250,000? I work somewhere which my employer doesn't give me any 401k, which is rare, no business plan, no simple, no nothing. What can I do? Can I take IRA? Yes, you can. So then the limit of you can defer money into your IRA account and still take at least $7,000. And if you're married, you can do $14,000. Whether your spouse is working or not, you can open two accounts. So that's another very powerful. So everybody has the choice. Now, once you cross $200,000, the answer becomes not that clear. Now you're in 22% bracket, 24% bracket. And depending on your age, whether can you have a cash flow, should you want to defer into take the Roth IRA and pay the taxes even at 22 and 24%, especially if you're in 20s, I would say go for it, because you are deducting, paying upfront, and never have to pay tax. You may live to 82, 92, that's 60, 70 years, and you can take money out at that time. So again, my choice will be straightforward. More, if you can afford, go to Roth, if that's the only thing you have. Now, if you start getting to that 400, 500,000 income, that becomes hard to lean towards Roth at that time. In fact, the Roth limit goes away, because Roth has a limit of 210,000 or under. Then you have a choice only for traditional IRA or traditional 401k, simple, and all those plans. So under 50, you can do 6,000. Over 50, you can do 7,000 at the minimum. Now, if you have a 401k, well and good. Most 401k, almost 65%, 67%, as per the recent numbers of the employees who are offering 401k, are giving you matching. Average matching is over 5% now. So there is no reason, if you have a job in a company which is giving you 401k, not to take it to the maximum for your deferral. If you can, that's the best thing. If not, at least take the matching percentage from your employer. I mean, for 1 year or 2 year, whatever, for whatever reason, if you make 200,000 and don't even have 27,000 to put aside, at least not miss the employer match, because that is free money at 6% on 200,000 income. That comes to $12,000 or whatever. At 100,000, that's 6,000. Even at that number is very, very attractive and it's free on top of the tax benefit you get. At age 50, you get 6,500 extra. Social Security ranges from 62 to 70. Preferred age for starting your Social Security, have in your mind 70 is the number that I'm going to wait till, because that's where you get 32% above what you would have got at 67, which is your base retirement age. Because then at 70, you kick on your Social Security. If you live to be 95, 25 years, you're going to make 32% more every year after that. So very, very powerful concept there also. If you have parents who make money or less money or are not working, if you have a business, this is another very tax savers credit is a very powerful way. How much money would you need? We talked about 75% of what you make in the last year. Creating a budget is very important. And in fact, that is important for all of us. We need to know where our expenses are, how much we spend, what we make, where the money is going, because that's the only way which will help you save money. Because if you track off where the money is going, you can do better in your savings. And that is very, very important, because we only have limited time. Time flies so quickly. And if you can cut, and I can assure you, if you can sit and spend a weekend or two for a few hours for the weekend, I'm sure you'll find a few $100 sitting going somewhere which you have not even used. You have not even touched that money, $10 here, $15 here, $20 here. Imagine that, multiply that by 15 or 20 in your retirement. That's how much money you're losing by not saving that much money. And of course, you need some money, have fun and things that we use. The problem is the things that we are not even using. We don't even know where the money is going. That's painful. That hard-earned money is just going away. That is a waste, and that you should definitely make sure that that doesn't go away. Budget helps you. Check your Social Security account annually. Very, very important. Consult a financial planner, CPA, if you need to, for your planning purposes, because after all that, you might have some more detailed questions. Unfortunately, we are not taking any new accounts, so please don't reach out to us. I'm not be able to help people in that area. But add beneficiary, that's another very important thing. When you open an account, everybody, traditional IRA, Roth IRA, 401k, wherever, and we change jobs, you must make sure that you have beneficiary, because in a 401k and a traditional IRA accounts, the beneficiaries listed on your 401k or any qualified account will supersede your will. So if you're on your will, unfortunately, if you have someone who was married and has been separated or divorced, and you did not change the beneficiary on your 401k account, the money is going to go to X. So just keep that in mind. This overrides your will. If you change your job, things have happened, things have changed, make sure you update. If you have 5 different 401ks, go back to each one of them, make sure their beneficiaries are listed, because all of them needs to be updated if something changes. And of course, if you are married and have only one income, your spouse should also be having a separate account so you can double your savings. So here we go. We have a quick survey, and we're going to come back and answer a lot of your questions. I know historically people have questions. Okay, I have this. So I'll wait and listen, because I think you will benefit from this question. Because go ahead, Azra. I think I'll let you take it over now.
Okay, that sounds good. Thank you, Roshan. That was a lot of really great information. So we received a lot of different questions, so I'd like to take some time to just go through them. So the first question that we got was, how do I add my wife to an IRA/401k plan via my work? She's currently only a beneficiary.
Yeah, that is, again, the same way. 401k accounts and IRA accounts, Roth IRA accounts, they all are attached to your Social Security. So the spouse can only be beneficiary. The account stays yours. You cannot have a joint 401k account. So God forbid something were to happen to that person, the beneficiary kicks in and they will get the money. But it is only after death, not during your lifetime, that you can make your spouse your co-account owner. No, you cannot.
Thank you. The next question we have is, how soon can an IRA like SEP or 401k self-directed can be converted to a Roth And are there any cost and limitations of funds or timeline?
Yes, you can convert into traditional into Roth. Now, again, this is a little bit of high-end tax planning. Normally, I would have ask you to come on live and ask question that way so we know. So here, the question is, how can you convert your traditional IRA into Roth? Is that a good, let's put it this way, is that a good tax planning concept? Yes, it is. It is very, very powerful in the sense that people who started, saving money 5, 10 years ago, they have, maybe you had a good job and you were making 300,000, the Roth was not an option, and then you've saved some money, but now you have more cash flow, but the income has dropped or whatever that reason is. You can start converting. And in fact, that's a very, very powerful way to making your taxable income slowly into tax-free money. And you can convert small amounts of money depending on what your income you have, because keep in mind, when you convert, you are adding a significant tax burden on your current year. So for example, somebody makes $100,000 now, and you are pretty much in 10-12% bracket, highest bracket is 12%. And now you choose to take $50,000 from your traditional IRA, which is a tax deferred and tax deductible account, which you took deduction several years ago, but now you want to convert into Roth. Can you do that? Yes, IRS allows you to do that. You pay the taxes in the current year when you do. So, but you do $50,000, your income goes from 100,000 to 150,000. All of that 50,000 literally is now taxed at 22%. You have to do it very carefully where you don't increase your bracket, or do it in a year where your bracket is very, very low. A lot of limitation. Do some reading and consult. I would say this is one place where you have to be very careful as to when you pull the plug down to $1 million conversion, which is not even allowed. So do the best way, which helps you tax-wise. And again, making it tax-free for life makes a lot of sense for a lot of people, and pay the tax even at this point also.
Great, thank you. The next question we have is, are there any spousal retirement structures where you can income split?
I didn't get the question. Can you repeat that, please, one more time?
Are there any spousal retirement structures where you can income split?
I'm probably not understanding the question. The spousal agreement where you can split the income. If they're meaning that they can contribute to the spouse's IRA account, the answer is yes. You file a joint account. If you're talking about withdrawal, either way, you will be taxed on your joint tax return basis, or whether A spouse takes it or B spouse takes it. All of that money is taxable in the year if it's a deferred account. So with that, probably I'll stop because I didn't understand the question fully.
That's okay. The next question we have is, when is the best time to switch from a regular 401k to a Roth 401k for tax saving after retirement?
I think it will be better to start. Even now, this is a new concept, even on 401k. Till recently, the only choice you had was a traditional Roth or traditional Roth IRAs. But 401k is a very new concept just a few years ago, where employers are able to offer you a Roth 401k. You could choose to defer or put all your money into a Roth 401k, up to 27,000 if you want, or 19,500 if you're under 50. Because that's, again, same concept goes. If you have the cash flow, if you're younger, if you're far away from retirement, that would still be preferred. If you are 100,000 or less income, if you can defer all 19,500 put into Roth, that Roth 401k, that will be the best thing. Or whenever you have cash flow, just keep in mind you cannot deduct, but you can put that money aside for many, many years to come without and not pay any tax at the end. And that's something you have to think. Now, again, if somebody's making 400,000 in the current year, I would probably hesitate to say, hey, don't take the hit of 33, 35% and do the Roth, because that becomes a little more attractive to go towards traditional 401k than Roth.
Okay, thank you. The next question we have is, My spouse and I make $150,000. We both put away 10% into our own 401ks, and I have a personal traditional IRA. If there are any capital gains, such as stocks and dividends, at which point does the benefit of all of these accounts go away?
Good question. So 401k, there is no limit. So that is a huge open window for if you are working for anybody, you could make 400,000 and still contribute to your 401k. And in your case, you're saying only 10% at 150,000. So that gives only 15,000 between the two of you. So there's a plenty of limit out there that you can contribute to 401k. Yeah, at a Roth IRA at 150, probably you're taking a Roth, not a traditional, because that limit is way below. So here's a very good planning thing that I think everybody should focus on. That how does this work? And this same couple making $150,000, how you take benefit of the two? Because going back and taking a step back as a financial planner, working with some of the retirees right now, that if you are retired, if you come to me or to go to any financial planner, they will love you if you have different buckets with money in when you're retired. Because if you have a brokerage account, which you have saved money, then you have a Roth account where you have saved a couple of $100,000. Then you have a 401k traditional IRA, which is taxable money. And beside that, there are other ways that many people have businesses on the side, rental properties on the side. They have permanent life insurances, VULs and all that you have. So if you have more buckets, and now you sit down and say, okay, I need $100,000. The goal for us is to take out money from your retirement, that $100,000 that you need. Depending on your age, if you're over 70, then Social Security is kicking in, giving you about $36,000 per person. You take some money from RMD because that kicks in. And then the goal is to keep your bracket as low as possible, taking money out from these sources, taxable, non-taxable accounts and all that. So we can keep our bracket low. And that is what you ultimately want to do. So to going now to planning side, if you have a 401k, you take the matching at least. Then for this couple who is $150,000 income, I would say go into Roth. That $6,000 that you're putting, if you can make it double, to one more thousand and make two accounts of Roths. After you have done the matching part, take both of them and then go open two Roth IRAs. Because now you have two different accounts. One is a 401k account where you have tax deferred money, and then you have Roth IRA, two Roth IRA accounts which are after tax money. You can do the Roth in spite of your 401k. So if you make that much money, you may not qualify for a traditional IRA, and which you probably don't need because you have a 401k limit still open, which is pre-tax. And then you take the Roth, which is after tax money, and you have two buckets that now you can plan for and build it.
Great. And this next question you may have answered, but I just want to ask it. So if you have a traditional 401k with a company, is it possible to convert that into a Roth 401k within the company, or do I have to open a Roth IRA and move it there from a traditional 401k?
Yeah, so most of the companies are very, very flexible now. Things have changed and changing very rapidly. Historically, if you are leaving the company, they would want you to wait. In-service transfers were not allowed for many companies. That while you're working in a company, you cannot take some of your money and move into a traditional IRA or within a 401k. If you're working there in service right now, while you're working, can you convert into Roth? Most 401ks will allow. I would suggest that you go to your HR and confirm that. Just again, going back to this thing, make sure that whatever you convert, that amount you will be adding to your income and paying tax on the top bracket of your income. So, the way the tax bracket works is staircase, starts with 10, then 12, then 22, then 24. So if you're already close to 200,000, if you add 10,000, the last 10,000 which you convert will be paid at 24,000, 24%, 2,400 tax extra. And that's why you have to be very careful when you take it out, what amount you take it out. because it sits at the top of your income in the year that you take it out.
Great, thank you. The next question we have is, how do we know how much you will get Social Security monthly income based on a 50,000 yearly wage?
Yeah, they take the best 35 years of your income. So there are two components. Once you have the 10 years of your service, which does not have to be 10 straight years, it has to be 40 quarters where you have made a very small amount of income. Very, very small amount, that a few $1,000 also every quarter would qualify you for that quarter. And like that, you have to have at least 40 quarters of Social Security taxes paid. That's the one thing that you qualify. So everybody will get that, 1,000, 1,500 range money, whether you have a very low or very high. The next portion, which differentiate between you getting $1,200 a month to $3,200 a month, is your 35 years of highest salaries they take into account, and that differentiates between me getting 1,200, Azra getting 3,200. So because she makes a whole lot more money than I do, right, Azra?
Thank you. The next question we have is, what should you consider when doing a defined benefit if I am a small business?
Yeah, defined benefits are very, very powerful. Is the challenge is the cost. It goes a long ways to retain the good team members that you have, because again, there's some discriminatory laws that you could apply to many of these plans. And for general public, I mean, what is a defined benefit plan? There are plans beside these two where small businesses can set things up where you can defer as much as $300,000-400,000 a year. Depending on the age of the participant. If you are a doctor with one or two employees with very, very low salary base, or they're just assistants and all that, you could. And especially if you have a business where you have only family members working significantly, and so you could defer a very significant amount of money. But there are a lot of tax laws. These are, you have to look into the cost which is you're gonna incur for other people. There's a vesting period. You can set it up between 1 to 6 years, that you can say 20%, 40%, after 1 year that it kicks in. So a lot of things goes in. This is a very detailed, I would say, definitely consult one-on-one with your salary information, how many participants, what your business looks like in 3 to 5 years. So a lot of things goes into before you set things up, because the cost matters a lot.
Is there such thing as a Roth 401k or a
Yes.
Roth 401(b)(3)?
Yes. And it's the same limits now, and most employees are offering it. You just have to go check it, especially if you are low income. I mean, if you're less than $110,000 income at your current place, married couple joint income, definitely you should look into that. And just keep in mind, just to add one more thing. So for example, somebody has only one income, married couple, makes $110,000. So again, I would say, see if you can do Roth. If you do Roth and you put the 6% matching that the employer is going to give you at, at 100,000, 110,000. So you can defer all your money into Roth. The matching the employer is going to give you will go into a traditional 401k. So there will be two different accounts if you're choosing Roth, because the employer is taking a deduction. So that money, the employer match portion, will be pre-tax money for you. So when you retire, you'll have two buckets automatically. The money that you have deferred into Roth and the money that employer gave you, that will be a taxable money in a taxable account. So there will be automatically be separated out into two. But yes, there is one, and look into it for people with low income.
Great. The next question that we have is, if self-employed, where you pay yourself a monthly salary and have only one part-time employee, how can you take advantage of simple IRA or SEP IRA being an S Corp?
The structure doesn't changes. You could set up these accounts in any form of business that you're doing. You could be a sole proprietor, C corporation, S corporation. That is not making a difference. What you have to look into is where you get the benefit. Do you really want to, with a part-time person, if you have that plan, chances are that person will say, no, I don't want to defer anything, because they have to defer for them to get the 3% matching. In worst scenario, you could choose that 3% instead of 2% mandatory for everybody. And if they choose not to contribute, you don't have to contribute for them anything. You can just take your 17,000 and walk away. And there's also a, you could set up a 1-year minimum work authorized, limit that they will not qualify. The new employees will not qualify. And this works for a lot of small retail businesses. There's a lot of turnover in small businesses. So you don't have to start contributing and keeping track of opening those. You could just choose that and give 1 year, and chances are many of them probably are not there. So that kind of helps employers to set things up and make sure that employees who are there are stable and they then get benefits too.
Right. Next question is, if I die before to take out funds from my Roth IRA, can my family members transfer to their Roth IRA accounts?
Yes, so there is a change now. You can. So what happens is where whoever is the beneficiary listed on the account, that's the powerful thing. And if you can leave it there, for most people, they say, I don't need the money. And whenever you pass on, that money is going to go to your beneficiary. And now there's a rule for they have to take this money out over a certain period before they could stretch out at their lifetime. But things have changed with the new tax law. They will get the money, in the same account, but they have to start taking money, all of it, within that duration or during that duration, which is, I believe, 10 years now. So.
Okay, great, thank you. The next question is, can you maximize your 401k contributions of 20,500 and also contribute towards Roth for 6,000 pre-tax at your job? Can you contribute towards both?
Yes, you can. The challenge here is because once you are deferring 401k to the max, the limit for people who have 401k available and you're participating, the limit on that is somewhere about 106,000, 110,000, somewhere very, very low for your AGI to qualify for a traditional. Because if you have deferred that, you lowered your income even lower, and you probably by 27,000. So if your AGI is below that 110 number, yes, you can take another, but then the question comes back to it. Do you really want to defer in a traditional IRA at 12%? Because now your bracket is only 12%, you're paying tax at 12%, which I would say look into Roth, because deducting a traditional IRA at 100,000 is a 12% deduction versus, I would lean more towards Roth. So do the 401k, lower your bracket, and then do the Roth, because that would make more sense tax-wise. But
Great.
the answer is, can you, if your income is low, yes, you can do both if you can.
Awesome, thank you. And just as a reminder, we're still going to take questions, but we'd like everyone, if they can, to fill out the feedback survey from today's session. I've put the link in the chat, but we'll continue, but your feedback is greatly appreciated, so thank you. The next question we have is, I don't have any income other than Social Security. Can I add to my Roth accounts from my savings accounts, and how long can I do that as I am 70 years old?
Yeah, sadly, the answer is no. The Uncle Sam wants you to have earned income. You have to have at least that amount of income. If you're 70 years old, you qualify for $7,000 deferral, either traditional or Roth, but you should have at least $7,000 income for you to defer $7,000. You could choose to defer everything, but you have to have earned income. Interest income, dividend income, capital gains income, Social Security income doesn't count as a earned income. So unfortunately, the answer is no. You have to have earned income.
Okay. The next question we have is, if you are maximizing your 401k and your IRA, are there any other additional retirement accounts where you can contribute or open?
If you're maximizing your 401k and your Roth IRAs, very good. Bravo to you. Congratulations. Excellent. If you have a business, then definitely there is a whole lot more. If one of the spouse is in business and one in working as a professional, a third component kicks in where you have a business plan where you can do, another beside this too. and you can set up a retirement plan at that level, and you can contribute even way more in that level. Again, if you have that kind of good saving, that's very good. But the answer is yes. You have to do a little bit more tax planning and make sure that the plan would have structure properly for between the two spouses.
Is there any benefit or drawback to move money between a traditional IRA into a Roth IRA or vice versa?
Vice versa is not allowed. I mean, you cannot ask for a refund from traditional IRA to Roth IRA. Again, as I said, you have to pay the tax of whatever amount you convert. So you will pay the tax. But going back from Roth to traditional is not allowed because, I mean, Uncle Sam is not going to send you a check back. So that's not allowed. So there's only one way, which is conversion, and that is also taxable.
Okay. A simple IRA can only be traditional or a Roth IRA. Is that correct?
You could be both.
What is the spouse benefit after the death of another spouse?
In what sense? In Social Security or 401k? Social Security, probably. Yeah, that's something you have to, that becomes very specific in what your spouse is making during their retirement, and Social Security probably will be the best bet for each person to go check it out, and you should, as we put in the slide, that you should at least have your account set up and monitor it once a year at least, or probably even more. And once you are in the retirement, then you have to go consult, because Social Security rules are even more complex in some cases than the retirement, all these that we are talking. So a lot of detail has to be provided before they will be able to tell you which is the best way to structure your Social Security benefits between the two spouses, based on their benefit, your benefit. Too many different variations can happen.
Great. Next question we have is, what's the deadline to maximize your contributions for 2021?
Depending on where you want to contribute, 401ks are December 31st. If I still remember, there were some changes were to be made. I don't know, because it was just passed last year, the act where they were talking about opening the limit to the filing date. I'm not sure whether they have done it yet or no, but historically 401ks have a limit of December 31st for that calendar year. So if you did not participate for 2021, probably you cannot contribute for 2021. However, you still have your traditional IRA and Roth IRA. You could contribute up to your filing date of April 17 this year, whatever, April 17. So the IRA window is more like a 15 and a half months. It starts in January of that calendar year. So in 2021, you started in January. For 401k, it ends on December 31st. So 12-month window. IRAs can go another 3.5 more months to January 15th, and you can contribute for last year till April 15th this year. So you have a 15.5 month window. So for 2021, you still have open window for traditional or Roth for 21. And of course, you can contribute for 22 also for this year.
Great. Next question we have is, can I open a Roth IRA for my children? They are still students and do not have an income.
Unfortunately, the answer is no. They have to have earned income, whether they are senior or whether they are school students. You have to have earned income to have a Roth. If you have a business, if they can work, you can make them work summertime and earn $6,000 or whatever they make, they can contribute all of that, or you could choose to contribute for them, but they have to make an income equivalent to what amount you want to contribute to them. You can choose to defer all of it, but earned income is important, is necessary.
Great. Can you discuss about those who are in their late 40s and some more aggressive saving options?
Well, if you have done these two and you got the full matching, you have done the Roths, very, very good. Again, as I said, there's always these rules apply to your, the same rule apply, because qualified money is very limited, right? If you start making a whole lot more money some point in time, people making 5, 6, 700,000, doctors and professionals, and they run out of this limits very, very quickly. So the same rules apply. Yeah, you're not getting the tax benefit of deferral, or if you're in business, then it opens another door, which is qualified plans. There are very, very powerful cash balance plan, defined benefit plan, DB plan as we call it, cash balance plans. If you are 50, you could defer, very commonly 200,000-300,000 per participant based on your income. So that is a huge, huge area, which is, very, very, it fits not too many people. It has to fit you, your business, your situation. Otherwise the cost will make you go back and say, okay, no, it's not worth it. So that's one area. But in spite of all that, even on top of all that, you could just have a savings plan where you're just having a long-term use of your money, which has been invested for a long period of time with not too many transactions, because that's where the capital gains kicks in. You can invest for long term and have money be doubling, compounding inside that account. Yeah, you will pay dividend tax on the dividends that you earn, but if you can minimize your capital gains on that account, that also works wonderful for a lot of people. So in my practice, it's very, very common. The same clients that I have will have their Roths, they have their 401ks, which many of them have moved to IRA now. And then you have a taxable accounts. So you have 3 buckets already that you have built in inside. And then, as I said, there are 3 more ways that you could look in. People do small businesses income, rental property income, and then you have, if you've already done, need be so on your insurance, if you have young kids and all that, VULs, ULs, and you could have built your assets there, which is, you could take some loans. So there are a lot of things that you can plan and defer and build. And yes, so there are ways to do even beyond 401ks.
Right. Can I open an IRA account if I do not have legal status?
Well, the way it works is legal, what you call it, you should have, for IRS purposes and for INS purposes, their definition of residency is very different. For IRS, Internal Revenue Service, they say if you have 6 months stay in the country, you do qualify for, and you have a PIN number. And in fact, there's a slide, if I'm not wrong. I probably did not focus on that, because if you have certain things, you could go back and take that. You should have a TIN number, you should have a job, you should be working, you should, so if you have an income already, you can contribute to that even if you are not a permanent resident, or if you are not even a citizen, but you have to be in the country. That's a requirement. You're working here and making income. You can apply for a TIN number, tax identification number from IRS, and then you can take that and open an IRA account or 401k account, which probably help you set up those accounts. So let me find that. Meanwhile, you can read the next question.
Okay, sounds good. Next question is, I'm 50 years old. I have not started retirement. How much should I pay yearly so that I can benefit from a retirement plan? If so, what retirement plan is worth it for me to take? Roth IRA or 401k?
Sorry, I got distracted here with this.
Sorry. It's okay. The question is, I'm 50 years old. I have not started retirement. How much should I pay yearly so that I can benefit from a retirement plan? And if so, what retirement plan is worth it for me? A Roth IRA or 401k?
Yeah, in absence of your income, you see the difference between now that you are 50 and no retirement savings. I would definitely, the answer would be the maximum. If you have no business, no 401k or anything, if you do have a 401k, the answer would be the maximum. And no question asked, if you can't afford to do the max 401k, you will probably getting 27,000 a year. That's the best way to go. If your income again is below 110 as a married couple joint, then go for Roth. If you can do that, not take the deduction, pay the tax upfront. Even now at 50, you have 22 years ahead to make a deferral. That's a very, very powerful tool. If you can put all that money into a Roth for 22 years, and you can walk away with all that money in your retirement, which RMD doesn't start for you for another, ever. Even now, you can build a significant amount of wealth for yourself at 50 with no retirement at this point, and not pay tax at all in your retirement. So yeah, if you don't have it, you have a Roth, you have a traditional IRA, same rule applies. Yeah, your limit is going to be 7,000, but even that 7,000 could be very close to 150 plus thousand that you can defer, and compounding could be 2, 3, 400,000 additional in your retirement. So yes, yeah, today is the first day of rest of your life, right? If you haven't done anything, yesterday is over. Today is the day, and today is the first day for the rest of your life. And many of us are in the situation in this country, and almost 40% people have not taken, 30% plus have not taken, which the slide we showed in the very beginning, have not taken. And these are the people who have been offered 401k with matching, and 30% of them never take a benefit of $0, where they could be getting $5, $6, $12,000 into matching, and they don't take at all. They just find it too confusing, too challenging, too whatever. They want to go, they feel better diet than take 401k, which is hard to believe, but anyways, yes, Azra.
Next question is, can we invest in Dow Jones?
Yes, in fact, we didn't spend too much time on the investing side, but Dow Jones Index is very, very narrow, 30 stocks. I would, in my practice, if you're young in your 20s and 30s, if you come and say, hey, can I put all my money into S&P 500? The answer probably will be, if this is the first or second year, you just start contributing to your 401k. Just one fund, putting all your money, not the best thing to do, but if you do that, I would not be too unhappy. At least you're contributing, you're taking the benefit, provided that you can take the volatility with 1,000 or 1,500, whatever you're putting every month. That will be a little better than the Dow Jones, because Dow Jones is a very narrow 30 stocks only. And so, preferred would be, you could have some international, maybe an international index would be a better choice. A US index, which is Vanguard's and some others, they give you very low cost, but then you're talking 6,000, 7,000 stocks into one index. Or international, there are 11,000 stocks in one index. And then you could have a bond index where you could have several different fixed income. The broader you can go, the chances of you losing all your money becomes literally zero. There's no zero, but almost zero if you can diversify into as broad as. Now, if you pick one or two stock, historically, we talk about Kodaks and we talk about blockbusters and companies who get wiped out, which were big companies, Sears and JC Penney's. And so individual stocks can become riskier, especially when you have 30, 40 years. I would just go broad as you can, because again, keep in mind, this is you investing for 20, 30, 40 years. If you can buy something which is not going to go to zero, probably that would be the indexes. Chances of S&P 500 or 500 companies going to zero is literally close to zero, impossible, close to impossible, not impossible, but close to impossible. So, and if you can make it even more broader by international index and a bond index, just 3 indexes. I mean, if you say I want to put $100,000 into 3 indexes, I would not hesitate to say not a bad thing to do. Just keep that and keep going for next 5 years, 10 years, because you diversified and you constantly adding money to it. It's a good long-term way to go. And the cost, very important, the cost, right? So indexes gives you a very low cost, whether it be Dow Jones, whether it be S&P, whether it be indexes as a market indexes, because those are the way that you can cut the 75% of your management fees of 1%, people like me who will charge you. So you can take that off, go directly, pick those broad things. Don't have to pay professionals. Why do you have to pay professionals? Because you can do it. It's the same thing. And what is shocking is in our profession, we are 2/3 of us are not even able to beat the indexes. 2/3 of professionals after the fees, our performances are even below what you can make in an S&P 500 by itself, which you will not pay any taxes. You can manage it yourself. So yes, absolutely. I mean, in my profession, you don't have a neurosurgeon will never tell you that you can do your own surgery. A dentist will never say, go take out your tooth. I'm telling you, you can. It's very easy. Cut your costs, do it yourself, learn about it, though, very important, educate yourself, and then you can very easily manage your money for a very, very long time.
Great. We have only 2 more questions that we're going to take. So the next question that we have is, as a self-employed who receives a 1099 earning, what are the ways that I can contribute?
Same rule applies. I mean, whether you're self-employed, whether you're working, the key part is if you're self-employed, you have earned income. You have 2 choices. You can go into traditional Roth, whichever you want, as a small limit of 6,000 or 7,000 based on your income, or you can set up a retirement plan. If you're the only one, self-employed, no employees, SEP will work wonderful. If you have very high income, you could contribute up to $61,000 into your SEP IRA. Again, whatever the percentage, but provided you know that you're not going to have any employees, because once you have employees, you have to stick to that matching percentage, and you have to offer the same from the employer, because this all comes from the employer, not deferred by employees. So if you have 2 more employees, you have to give the same to them based on their salary. So keep that in mind. So yeah.
Okay. The next question we have is, suppose I retire at 70 and no income and take Social Security at 72 and a 401k distribution at 72 and use 2-year window to convert to a Roth.
Okay. I mean, there are a lot of tax planning at that point. I don't know whether now you want to convert into Roth because you have your RMD is starting. It may not be well planned, because see, the power of Roth is the time that you get in compounding. If you're 70 years old and you have just contributed into Roth, you did not deduct anything. I mean, you could be a 25% bracket, you contributed into Roth, you pay the taxes, but then the Roth power is of compounding inside. That $7,000 over 10, 20 years will become 10 years will become 14,000 and 28,000. And all of that is tax free, but provided there is a time. But if you don't have time, because eventually, if you're contributing at that time, it is not that attractive of a tax planning at 70. It is a super, super good planning at 20, 30, 40, to have a Roth with traditional IRA and definitely conversion. I don't know whether I like that concept. Could be very unique to your situation, but in general, not a good concept at 70.
Great. And Roshan, the last question that I have for you is, for somebody who is just getting new to retirement savings, what are the few pieces of advice you would give for them today?
I will start with the very first one that I started with, that savings is where you grow your wealth, because I cannot emphasize over the years that I have been in as a CPA practice and 25 plus years, that in our country, we just lack how to save. I mean, if you can learn how to save early, people who are early in their profession, in the 20s and 30s, I cannot emphasize more the power of 401k matching that you could get. And more of our Jamaati members are becoming professionals, working for good companies, where they're offering you 6% free matching. Just no reason, absolutely no reason to miss even 1 year of that matching. Having the second goal as at least bare minimum 10% of your income. If you make $200,000, there's no reason that you are not able to put aside 15% or 20%, because at 200,000, your goal should be 20% savings. At 300,000, 30%, and on and on. It's not 10% at 500,000, no. Because if you are just doing 10% and making $500,000, that's $50,000. That means you're spending 450,000 out or paying in taxes and all that. That is very, very poor financial planning versus somebody who makes 100,000 and can put aside $27,000. I mean, that person is very strong in my eyes. So let's put two people. If two people come to me and they say we both have $1 million, hey, that's awesome. Very good. You put aside $1 million. Well, when we dig more into it, we find out one person makes only $100,000 and they have put aside $1 million in their retirement account, in their qualified account, in Roths and traditionals and all that. The other person makes $500,000 and they only have $1 million. If they are 2 years or 1 year away from retirement, the person in the 500,000 bracket is in a very bad shape because their standard of living is right there, and you only put money aside for 2, 3, 4 years. That's a big problem, right? So it all depends on your income. It's not what you have. Don't say, oh, I saved $10,000. Yeah, it was very good when you made 50,000, but it's absolutely bad, negative if you're making 3, 4, 500,000 and saving $10,000. That's just not the way to go. So adjust yourself, whatever it takes for you to maximize, save in the accounts that can help you defer taxes. Very, very important, because not only that you don't pay tax in these traditional Roth and all that, you don't have to pay tax for next 30, 40, 50 years, and you choose when you do RMD, and that money will probably be there for next 20, 30 years in your retirement. So imagine that money, which either you pay tax now, a bird in hand is way, way, way better than bird in the bush. So if I have a choice not to pay tax today, I'll take that anytime, because, why would I worry about paying tax 40, 50 years? I'll worry about that and then. Hopefully, just like the story in the beginning, the horse may start talking and Uncle Sam may choose not to tax us at all and make all our retirement accounts free, right? So I'm optimistic, keep my tax money, and hopefully someday they'll say, okay, all those people who have saved don't pay taxes. So yes, save the money, build your retirement, and I think you'll do good and will help you a lot building your quality of life. That's our goal that you all should focus on.
Amazing. Thank you so much, Roshan, again, for your expertise and knowledge throughout this entire session today. We really appreciate it. So thank you.
My pleasure. Thank you, everybody. Thank you very much. Enjoy.
Just as a few reminders before we leave, there will be a session 2 that will be hosted on February 20th, and it'll focus on investments, retirement risk, compounding interest, and more. The link is posted in the chat currently, or you can look out and register for it during the Smiley Insight website and newsletter. Again, the link for today's recording and webinar will be sent out along with a survey very soon. And if you have any questions, please feel free to email our team at rsp.epb.usa@gmail.com. Again, we thank you all so much for staying for this webinar, and we hope that you have a good rest of the day. Everybody,
have a good day.